Alrighty. So, Matt, what's up, man? How you doing today?
Dude, Michael, good to talk to you. Good to see you. How you doing?
Doing amazing. I am so excited to bring you on and share your story, man. I think a lot of people are really going to resonate with your story, and so this is a live show, and so as people come in, remember to have questions for Matt. He's a wealth of knowledge, and we'll save those for the end, and that way he can share some wisdom with you guys. But for people who maybe are just meeting you for the first time, um, you have a really unique story, man, and I'd love for people to kind of get to know you. So tell us a little bit about you and how you got started in real estate.
Yeah, sure thing. First of all, thanks so much for the opportunity to be here. It was great getting to know you at Investor Fuel and getting to know your business partners, and I'm honored to be here. So, how I got started in real estate, I really got involved backdoor. I come from a line of four generations of engineers. I was a chemical engineer by trade. That's what I wanted to do. I thought I wanted to do. That's what I went to college for. I actually discovered real estate investing outside of the country. I was awarded a Fulbright scholarship to study in Madrid, Spain. I did an MBA. I did it all in Spanish, every negotiation, every class, every presentation, every test, everything. And we did a module on debt, on finance. And I that really made sense to me. The stocks, that stuff didn't resonate with me. The trading, the valuations of these big companies, and I really latched onto that one piece. And so when I got back to the United States, I knew that I wanted to get into real estate. And I bought my first single family property in Allentown in 2014, thanks to that program, and it exposed me to entrepreneurship and real estate. And then I've been buying ever since, and I've been growing, and I recently went full time in real estate investing.
Wow, that's incredible. So I had no idea that you were that fluent in Spanish. Like you literally were able to negotiate deals in Spanish. That is so cool.
Yeah, that's right. Yeah, the whole MBA curriculum was carried out in Spanish, so it was my second language. I did my further education in.
That's really cool. So you went to college, you got your chemical engineer degree,
Yep.
and at what point did you decide I wanted to start buying properties and investing in real estate?
Yeah, that's a great question. I practiced chemical engineering for 3 years before doing my MBA. I came back to the States in 2014, so it had been about 3 years or so of professional work as an engineer, and then my MBA. So it was 4 years after I graduated college. I think I was 26 at the time.
Okay, so 4 years after you graduated college, and you're like, what gave you the real estate bug? How did you hear about it? What really made you have the confidence to dive in? Because a lot of times it's hard to balance that investing and a full-time job. And I know
Oh
that
yeah.
was that's how you made your money. So like, kind of help me understand that.
Yeah, so I kind of was double hatting. I was working full time, and how I got the confidence, I guess, just from the MBA curriculum. I thought, well, I've studied business academically. I can dive in and do this. I was involved with a group of investors back when there were foreclosures. It's hard to believe. Every Saturday morning, we would go around and we would see 8 to 10 properties. Typically, they were foreclosures, and I got confidence from just going in properties, looking at them, talking with investors. Is it a good deal? Is it not a good deal, and why? And then I would put in offers on ones that I thought were good. I think I missed two and got, so it was just going to see the properties, putting in offers, evaluating why they're a good deal or not good deal. That's how I got the confidence. And the other part of it too is having a W-2 income is an advantage for when someone's getting started, because banks like it. You could get good loans with good terms, and so I could make offers confidently because I had a good engineer salary. So that helped with my real estate when I was getting started.
I think that's such a good point, Matt, because so many people talk about just jumping and kind of burning the boats per se,
Yeah.
right? Which is actually what I did, and that works for some people. But I actually have a few people who I help coach to get into the business, and like they're all wanting to quit their job, or they're all in different various phases, and some have, and some are in the process. And you know, it's easy for me to say just like quit your job because I
Yeah,
did, but it's also not for everyone too. And so I like how you pointed the fact out of the financing and how banks like the W-2 salary and it's very beneficial for them. And so how long did you do the wearing multiple hats at the job and buying properties before you finally decided it's time? Because I know right now, as we're recording this, you are no longer at that job, right?
that's correct. Yep. I'm doing some work for a developer. So I took like a pseudo job, but it's few hours a week and it's less than part time. So but yeah, I'm no longer at that job as we're recording this. So I was there for, it's in the industrial gas. It's a big chemical company, the industrial gas business, and providing oxygen during COVID and other things. Like it touches all these different sectors. And, but I was there in all 12 years in the chemical space, working as a W-2 employee. So with a year and change for my MBA. So I double hatted for a long time, since 2014. One of my mentors is a big developer here in Allentown, and he kind of says maybe I stayed too long, but I wanted to err on the side of I'm a cautious person. I want the deals that I do, I want them to make sense. I underwrite things conservatively. I want to have a certain degree of certainty that when I'm going to do something, it's going to work out, which is good and bad. Many entrepreneurs just want to go get it. I'm a little more cautious. So I double hatted for, I guess, almost 8 years from 2014 till 2022. And it was nights, it was weekends. And I'll tell you what, it was a grind because you're trying to schedule appointments outside of working hours or take a half day off. And I was trying not to mix work and real estate because I didn't want the perception that my performance was being affected or not affected by things outside of work. So I was keeping things on the, pretty quiet and not opening up at work about what I was doing. And I think that was smart. But at the same time, it's hard to maintain that and still be an investor. And I wasn't doing anything like this. I wasn't doing social media. I wasn't online. And it was hard to do. But in a way, I'm glad that I did it because it really helped with the bank financing. I could do the next deal, the next deal, the next deal, cash out refinance, the Burr method, all that stuff. And they were willing to work with me because of the income.
Yeah, man. I think it's so good for people to hear that and to know that just because this person does this or this person does this doesn't mean that it has to be the way that you do it. But
Right.
I definitely have to say I'm very impressed with the amount of patience because after I met you at Investor Fuel, which is a mastermind that Matthew and I are a part of, I was like, you have this much going on in your real estate business and you're still working your job. I'm like, holy cow, you are patient, man. So kudos to you for building what you've built, which is extremely impressive, all while wearing multiple hats because I did it for about 8 months.
Mm.
And, I'm at a little different point in my career than you. You're a little bit ahead of me, but I was like, I can't, how does anybody do this for any longer? I was totally tired of it. And so the fact that you hung in there for that long is super impressive. And it's really cool seeing that. So well done, man. That's
Yeah,
awesome.
thank you. And I wouldn't have held on as long as I did if it weren't for the benefits of the bank financing. The banks were really willing to work with me, which helped me buy more deals, I think. So it wasn't just like a total grind. There was benefit for sure for the real estate side of things.
Yeah. So I think the biggest component, like especially as banks tighten and squeeze that right now,
Yep.
especially, is people are wondering, what are the banks going to be able to do? So let's talk about that a little bit more. So, like, when you were at that position, what was the difference between somebody who was maybe self-employed and you in talking to the banks? Like, how do they look at you versus somebody who didn't have the W-2 job?
Yeah, well, the banks are always going to ask for 3 years of tax returns, but they really like if there's 1099 income or there's self-employment income, they really scrutinize that, and because it's
Not
not.
guaranteed,
Yeah,
right?
which I disagree with, but I mean, I guess they've been burned, and but when the employer is a big employer, it's a Fortune 500 company, just they look at it as it's more secured income. And if the property, they'll look at the property first, whether it's a W-2 applicant or a 1099 or self-employed applicant, they're always looking first to the property and to the collateral. So if it's a really good deal and you buy a really discounted property, they may still be willing to work on it with you and finance it. But if the deal is pretty good or average, then they're going to look at, they're always looking at how am I going to get paid back? So first it's the cash flow, then it's the collateral, the property, but then it's the borrower. Do they have good credit? Do they have good liquidity? Do they have good income? That's what they're looking at. That's all they care about. They just want to know, how will I get paid? So if the bank has more of an appetite for loans or not for that type of loan, then they may or may not have more of an appetite. But really, it comes down to the property. And but having that W-2 income certainly is a differentiator for sure. They just feel that they'll get paid back more easily and that you can support yourself. You're not relying on the property to pay your own bills.
Okay. Yeah, that's so true. And, what do you say to somebody right now who is at their W-2, who may be a lot earlier on in their career, who is just feeling spread way too thin, like working the 10 hours a day at their W-2 with aspirations to go buy real estate and achieve that financial freedom that everyone wants? What do you say to that person who's juggling and wearing those hats right now?
I'd say stick with it and keep it up, and don't get discouraged. It will be hard to manage and juggle, but when you accumulate the properties that you'll need to be financially free, that's also going to be hard because there's going to be things that break. There's going to be tenant issues, or contractor issues or whatever. So it's a part of the process. It's a part of the journey. Keep it up. Don't get discouraged, because having that portfolio isn't easy either. I think it's an idealized notion that it's passive income, and once I just have this number of units, I'll just be able to do whatever I want, and it's no work. It's not really true. There's no such thing as truly passive income in this business if you're a landlord, and so just keep it up. It's tough, it's hard, but it'll prepare you for the journey ahead. You can do it. You can do it.
100%, man. I think that's the biggest thing, is just realizing that it's a journey and it's not an overnight success, get rich quick.
Oh, yeah.
Like building a portfolio, and not just building a big portfolio just to build a portfolio, but like stabilization, predictability, keeping the vacancies to an all-time low. Like that takes a lot of hard work. And one thing that I guess we'll switch gears a little bit and kind of talk about team and how you can manage all that while working a W-2 job. Yeah. Because one thing that I noticed about you is like, you didn't really have this great big team. The sexy thing right now is scaling. And, I talk about it and we have a big team, but you were doing a lot of this without having a great big team. That's right. What were the key components of being able to juggle all of that simultaneously to still putting in that time?
Yeah, that's such a good question. And it's something that I think about often. Do I insource? Do I outsource? And when I was working full time, and to this day, I work with a third party manager here in the Lehigh Valley market. Great property manager. They're a little bit more expensive than the competitors, but the service is worth it. And just annual turnovers will just destroy everything. So I'm willing to pay a premium for that manager. But I've outsourced most functions, and including property management. And fortunately, there's a good property manager in my market. I do mostly market rate stuff, and they also do Section 8, and they're good at it. The way that I think about it, Michael, is just because I need money doesn't mean that I need to start a bank, or just because I have an insurance policy doesn't mean I need to start an insurance company. Just because I need to paint an apartment doesn't mean I need to start a painting company. It's the same thing with management. So every function that I take on, it has to be critical to the success of the business, a true core competency. And I'm trying to outsource most things to keep freedom high and overhead and I guess people issues low. And that's the path that I've taken for now. But that might change now that I'm full-time in the business, but that's what's gotten me to where I am.
Yeah, man, I think you have taken a very strategic approach at it, which doesn't surprise me, being that you coming from a chemical engineer background,
Yeah.
versus somebody like me. I kind of jump off the cliff and then figure it out on the way down. And so I really love the thought process behind it, because somebody might be thinking to themselves, well, if this property management company is going to charge me this much more, I'm going to be losing this much money. But in reality, you didn't have to hire an employee. You didn't
Right.
have to train that person. You didn't have to babysit them. And at the end of the day, they're going to have the best service because that's what they're the best at, that one thing. And that's powerful. That's something that, as any entrepreneur, we all have all these crazy ideas to, oh, well, shoot, I have 50 properties. Like, I'll just go start a property management company. It'll be easy,
Right.
right? And then we catch ourselves getting yanked in this direction and then yanked in that direction. And all of a sudden, we're dropping all these balls. Versus if you just focus on, this company is really good at that, and let's just let them be really good at that, and we're going to have a great partnership. It's going to be awesome, and it's going to be handled with the best customer service because that's what they're good at. And so I love that you've figured that out without having to think that because you're paying them a higher price, that, or a percentage, that it's taking away from your profitability.
Oh yeah, yeah. And the thing is that working a full-time job, all of my extra energy and focus had to go into acquisitions. It's the only place it could go. It couldn't go into, well, what's the status of this turnover? It couldn't go to, I need to do this repair, or I need to follow up on this tenant relations issue. All of my focus had to go into acquisitions and finding the next deal. I purchased deals and properties so that all of the downstream stuff could be accounted for and paid for because it was paid for by the deal. So then once I got the property purchased and onboarded, I handed it off to the manager. And then that was, of course, I would do monthly check-ins. I look at my reports. I follow up fiscally, making sure everything is making sense and being managed properly. But I passed everything off to the manager. And then the manager's job was to take it from there all the way to disposition when someday I would sell it. So I only focused on acquisitions, and really that's what I want to focus on only in the business. And I outsource the rest. So that's been my model because I was an employee. I couldn't start up a management company or do these other things or start a contracting company. I only acquisitions. That's all I had time for. So
Yeah, man, I think it's brilliant because everyone always knows, you kind of make a good investment when you purchase, right? So
yep.
if you don't have the acquisitions component, you really just don't have a business, right?
Right.
So I'm curious, we're pretty high volume of acquisitions. We're good at outsourcing or sourcing deals. And so how did you go about finding properties? How did you do acquisitions while wearing that other hat?
Yep. So I had an advantage in I'd say the first 3 to 4 years, in that there were properties available on the MLS that could make sense. So I initially found them on the MLS up until about 2018. After that, though, but more relevant for today, I do a lot of direct mail. I send a lot of letters every month. More recently, now that I left my full-time chemical engineering role, I started up my website, my social media platforms, pay-per-click stuff, ads. So that's all brand new because I didn't want that stuff, which is easily findable, to affect my income, which would affect the financing, which would affect my ability to do more deals. So I was careful, but now I'm doing all of the inbound and outbound channels, likely that you are. And I think you even wholesale the property near me from across the country like 6 months ago. So that was cool. We talked about that. So I'm not at that level yet, but I'm doing the online stuff.
Yeah, man, it's so cool, like what digital advertising can do. And it's really just casting a
Right.
message. And if somebody is looking to sell their house in Allentown, the person who was looking to sell their house in Allentown happened to be living in Vegas, which is
Yep.
why they found our advertising. And we were just able to service that customer, which is pretty cool. And so if somebody's looking to sell their house in Allentown, what do? They just like go online, say, sell my house fast, Allentown, or how do they find your advertising?
Yep. So for the direct mail ways, so the outbound marketing, I'll just I pull the public data, and I have searchers that are looking for people that are behind on their mortgage payments or taxes. There's not as many these days, so it's smaller lists. all landlords, people that have been living in their house for more than 40 years, code violation, all the typical lists you read online. Water shutoffs, all that stuff. So I have searchers doing that. Then on the inbound side, doing ads like Google ads right at the top. If someone types in, I need to, how to sell my house fast in Allentown in Google, one of my ads will pop up in the ad bar with other competitors. And then my website will pop up too. It's not ranked as highly as it should be yet, but it's newer. I think it's 4 or 5 months old. So and then Facebook stuff, boosting posts, stuff like that, social media. So and some of the channels feed the other channels. Like I'll put a QR code on the letters and say, here's our website, and then it adds credibility. So sometimes you can't really pinpoint exactly where the lead came from because they could have visited the site from your letter or whatever. I'm getting better at that stuff, but all those ways.
Yeah, man, it all works. No, I think there's one thing that's really important for all the listeners and whoever listens to this to understand. There are a lot of real estate investors in this country, a lot of them. But the biggest thing that I think is the most important thing for everyone to understand is not all of us are treated equal. And what makes you different, Matt, versus the other people who are in Allentown who are trying to buy houses?
Oh yeah, I'm so glad you asked that question, because our value proposition to the market is that we can provide the quick cash offer, seamless process, just quick, simple offer that wholesalers and flippers can, except for the fact that we're the end buyer. So there's no middle person that needs to make a cut or a profit. So we can offer more than other wholesalers in the area, other flippers, and we can still offer the same service or better service because we're the end buyer. I'm the end buyer. There's no one else. I don't wholesale or flip properties. I just buy them. So I can typically offer more, and we outbid competitors because of that, simply because it's all in-house. So that's what Pezon Properties does, and why we're successful here in this marketplace, because there's no other middle person that needs to make a cut of that profit. The seller gets it, basically.
Yeah, they keep it in their bottom line. I love that.
Exactly. And then they want to work with us.
I love it. Yeah. So, and then obviously then you service them at a high level too, along with, the process and all that. So, man, that's awesome. So what do you think about the current state of the market right now? And for guys that are the only exit strategy is they have to buy it at this deep margin because they're going to sell it to somebody like you. Like what do you think about that component in the market currently?
Yeah, so that's a little bit of a packed question. I mean, I could speak nationally and I could also talk locally. So I'll take local first. Yeah. So I could say locally first. The Lehigh Valley is actually in a great spot location-wise. I just saw a report in the news yesterday that this economy, so just for everyone that's watching, it's an hour north of Philadelphia, an hour and a half west of New York. It's the economy here in this MSA is bigger than 3 states. So it's a diverse economy, and people are coming from New York, New Jersey, these high tax states where prices are really taking off, that people can't afford to live, and they're coming out to the Lehigh Valley, still very, very connected. Still, the beach is an hour and 15 minutes away. You have New York, Philly, all these things, but their jobs, the cost of living is better. So here locally, it's disposition. It's fine. It's not a challenge because prices are continuing to appreciate even with interest rates going up. There's demand for housing, and there's going to continue to be demand. The population is expected to grow by 100,000 more people over the next 30 years. It was just estimated a few weeks ago, and it's just locally it's fine. Nationally, I think that folks need to be careful. The Fed increased we're recording this in December when it's live, so everyone knows, but the Fed just increased short-term interest rates yesterday. The overnight lending rate, I think we'll continue to see rates tick up. And as that happens, properties can become more and more unaffordable or less affordable. And so I think folks need to be careful, because the end buyer is going to have a higher monthly payment, incomes are adjusted for inflation are not really rising much. So the end buyer is going to have a harder time affording that house. So just be careful of your margins, and make sure that you have a solid exit strategy depending on your market.
That's great advice, man, and it's so true because, you know, the interest rates have been going up, and how I know nobody has a crystal ball, but do you see the market changing like quarter two, quarter three of next year? I mean, obviously it has a lot to do with the Federal Reserve and what they decide to do, but
Right.
do you have any insight on that?
Yeah. So like you said, I have no crystal ball and I'm no economist. But as a real estate investor, and as many listeners are doing or aspiring to be, when you take on debt, you position your balance sheet next to the Federal Reserve or next to the federal government's. And over the last few years, there have been, I think, $4 or $5 trillion of deficits, huge, massive numbers. And so I don't think it's fiscally sustainable to have a high rate in the U.S. To service. I think there's going to be problems and unrest when interest rate payments are more than Social Security or military spending or other big program spending. So I think that it would be difficult to fiscally sustain ourselves at higher interest rates long term. So I think rates will eventually moderate, plateau, and start to tick down. Whether that's Q2 or Q3, I don't know, but of next year. But I don't think that I think that I think something's going to break. I think that rates have gone up so fast, so quickly. I don't think we fully understand the impacts of those quick accelerations in rates. There's a large lag there. Even if you look at inflation with all the money printing, how long it took for the inflation to really catch up. I think stuff's going to start to break, and we'll see. We might have a mild recession next year, and rates will taper, will plateau. But again, I have no crystal ball, but that's what I tend to think right now.
Yeah, well, it's very logical thinking, and I agree with you. And so, one thing I can say for the Las Vegas economy is I have watched it go up like a roller coaster, and I've also watched it fall down like a roller coaster over the last 3 to 6 months. It is kind of just crazy, and it's really, I think, has a lot to do with the hedge funds that were buying and inflating the prices, and then all of a sudden they just stopped, so the prices just started falling. And so it's been really interesting because I invest a lot in the Midwest, to see that market and how little it's been affected, probably similar to Allentown, and to see a Vegas market and then California even. So it's very interesting to watch how this all plays out. Let's switch gears a bit here, man. So you talked about how investors should be careful underwriting the properties. What have you changed in regards to underwriting, and have banks changed their debt service coverage ratios on you at all to this point?
So not on me. I've been fortunate to build relationships over the last number of years with my lenders and maintain deposits at their financial institutions. And so they're not, they have liquidity also as collateral with the properties, so they're not as concerned. But for those that are starting out, I would recommend, so for underwriting and as you're looking at deals, as I said before, just be careful. Look for really think about where you can. So at the end of the day, it comes down to what's the income, what's the expenses, and what's the ratio relative to your mortgage. The bank just wants to see that they have some, whether it's 20% or 30% more than the mortgage payment in income that can service that mortgage. They just want to get paid back. So if you're a newer investor starting out, frankly, or any investor, just be prudent right now. Make sure that you're really hitting your rents, that you know what your rents can be. Look at HUD's data. Look at the housing. Here it's PHFA. There's Lehigh County Housing Authority, Northampton Housing Authority, the various cities. But look at the housing authority. Look at where the rents are for Section 8, for other public rents, fair market rents, HUD. Look at where they've been over time. Have they escalated at 10% over last year, 15%, or have they escalated by 2%? And that can give you a sense of where they might go. So really look at your income. Where can I reasonably expect my income to go? And then next, look at pricing. Have prices start to plateau in your market? Are they continuing to escalate? Here, they haven't changed. They've continued to go up at the same rate as for the last 6 years, just because of people coming to this area. And then look at your expenses. Do you foresee taxes going up in your area? What type of mortgage do you have? Is it adjustable rate, and where do you think rates will be, or is it fixed rate for 30 years? How fast can you grow rents versus so where are the rents right now? Can you take them from 900 to 1200 or not? And then are your expenses going to be consistent? And then the value. So at the end of the day, it's just how sensitive do you think your income is, your expenses are, and the value of the property, and just add a little extra security buffer to each of those things that you're looking at, and then do the deal. Also, don't wait though. Like if a deal makes sense, do it. I wouldn't get scared because the market might be shifting in your area, but just go into the transaction with your eyes wide open, and talk with other seasoned investors to get their feedback.
So much great advice, man. Yeah, if you guys are getting value from this, whether it's replay or live, please make sure to share this out. Matt has dropped a ton of value, and the more people that hear it, the more people that can get the value. So thank you for all of that. Now, as you said that, I started thinking of a conversation that I just had with one of my buddies he's bought 50 properties this year, and he's a buy and hold guy. That's all he does. He's not a flipper. And when he was flipping properties, when the market was just going up like crazy, you have to worry about taxes and all that on the back end. But what he said is happening right now is because of the run up of house sales earlier this year, and the slight decline right now is he's actually making more money on the refinances than he would make if he were to flip the property, because the appraisals are kind of funky, at least in the Midwest market. And so I'm curious, like for somebody like myself who, I have not been, I would say, known as the buy and hold guy. I've been very transactional. And at this point, I'm seeing an opportunity to start holding a lot more property. But I don't have, a huge portfolio to date. So I'm curious on your thoughts of, I'm talking to this guy who has hundreds of properties in his portfolio. And he's like, dude, this is the type of property that you should be buying for cash and then refinancing and collecting your $30,000 profit on the equity that you pull out. But I'm kind of in this back and forth battle. Like, what do you think about that business model and using that money to kind of consider not necessarily just your income, because we still flip properties, but this is an addition to it. So what are your thoughts on that? I'm curious.
I mean, that's what I've done for years. I've the Bigger Pockets brands it the Burr method, the buy, rehab, rent, refinance, repeat, and that's what I did while I was working full time. That's what I still do, and I think it's a fantastic model. I think it's sustainable because when you buy a property, you're helping the seller, you're helping the tenant, but then the bank gets a good deal, and it's just a really smart business practice, frankly, because you can, if you're buying a good deal, if you're buying the property for 55% of what it's worth, you put that other 20% into it, you're up to 75% of what it could appraise for. You get a 75% loan to the value. It's just smart. You can cash out all of the money that you put into the deal and do the next one. So I think it's a strong model. Now, for those getting started and that are looking to do this, it's a tricky time because of where rates are going, and it depends on the lender. Some lenders fear more of an economic pullback than others. So make sure if a bank tells you no, we can't do it, just go talk to the next bank, because there are lenders that will do it. You just have to talk to 10 or 15 or 20 lenders, some nationals, mostly local, or lenders that understand that are national, to do that refi. So, I mean, I love that business model. You just the key though is that the lender must understand what you're doing, and they must understand how investors think, not like a traditional, oh, you're not putting 20% down, so I can't do it type thing. You'll still put down the 20%, but they'll cash you out later.
Right. So live example of a property right now that we're looking at is we're looking to acquire it for 145, and it needs about 25 to 30 into it. The value after repair should be in the 225 to 230 range. So if we crunch the numbers, we would be able to pull out all of our cash into the deal and likely another 10 to 15, maybe even $20,000. And then if we were to flip it, depending on what it sells for in the middle of the wintertime, I mean, we might make a $25,000 profit. So if it were you and you could hold this amazing asset in a great neighborhood, I mean, would you just go ahead and burr it out and then keep doing what you're doing and keep moving?
Yeah, I probably would. I definitely would, because I've only tried to flip, I think, 2 properties, but then you have the transactional costs, and then you're paying long or short-term capital gains. So I would, and that's the model that I've been doing for years. I mean, I think there's a time and place to flip and wholesale, and I think it makes sense. But I'm definitely, my mentality, and I think it plays in with my business model, because I'm from the Lehigh Valley. I went to school here. I went to college here, and I'm not trying to profit off of a situation, or I try to offer as much as possible where I'm able to make a profit as the investor, but the seller does too. And I'm thinking long term. I'm thinking 10, 20, 30 years down the road, and not like right here, right now. And by refinancing and pulling out equity, it's helped the seller get paid a little bit more, and it's also helped me keep the properties, pay less tax, and stay invested in my community long term. So that's the route I've chosen to take. Now there are others that flip and wholesale. That's fine. Like, that's great. Do what you want to do. But I've always understood the long term model a little bit more.
Man, I love that. It's such a, like, for somebody who's as transactional as I've been over the last few years, it's such a mind shift, because there's so many benefits to that strategy of burring out, and you got the tax benefits, you got the balance sheet, it's so many things. It's incredible. So for the person who is, we're going to shift gears back to the W-2 person here for just a bit. They are looking to get into some properties and to get in the habit of doing this whole thing. What are some ways that they can come up with, if they had to come up with a down payment or renovation? We talked about this offline of some strategy that you use with some credit with banks, and I thought it was really cool. And would you be willing to share that?
Yeah, for sure. I mean, I think the first thing, that if someone's looking to buy their first or second or third property, and they're looking for ways to come up with the down payment, I think what I did when I was getting started, I said, okay, what are my assets? And I had a car that I had paid off. That it was I think at the time it was maybe 5 or 6 years old. So I had bought it basically new, paid it off. I took out another another note on the car. And I think I paid like 2% through the employer's credit union. And then I invested in a property that has yielded much, much more than 2% in profit. So that's one thing. Just look at the assets you have and see if you can either refinance them. And I wouldn't like rush to pay down student debt or anything like that. I would keep the cash and then look to invest that, not try to get rid of your loans.
Hidden equity, right? It's hidden equity.
Exactly. Oh yeah. Yep. Next, so you could take 401k loans. So if you have a 401k with your employer, you can borrow from your 401k. I did that. I think for 8 years, I had a loan out all the time. And I would just, it's like, okay, well, I'm taking it out. Like maybe I could have got, 10% in the stock market. But when I bought a property and then I was no cash into the deal, my return was much greater than 10%. It just took some creativity. So next would be your 401k. Also, as you get more experience, there are loan products. So you could do a line of credit in your personal name. So that's access to cash. It's typically a lower interest rate than credit cards. I never used a credit card to purchase a house or take a cash advance against my car, but I know people who have when they were starting out. So credit cards, a line of credit in your personal name. And then also there are business lines of credit that you can get if you buy a property in an LLC. Those are harder to do. I think I was in business maybe 3 or 4 years before I got one of those. And eventually one of my lenders approached me and said, we can put a second lien, a line of credit behind our first mortgage, and we'll go up to a certain amount. And then you can use that to buy properties so long as you refinance them with us. So hopefully that's a roadmap of different lines of credit, like starting from right away all the way into maybe your 4th or 5th year. But I think that's like 5 or 6 things that you can explore right there.
Yeah, and that's a lot of really good advice because a couple of those are kind of obvious, but some of them, like the 401k, some people just
Mhm.
may never think of that. It's like, oh, I didn't even realize I could do that, and if I did, it seems really risky to invest it in real estate. But when you understand how this process works, you realize that you can get that money right back out as long as you buy the property correctly and then have a relationship with that bank. So,
Yep.
appreciate you sharing all that stuff, Matt. So. Yeah, man. I mean, we're coming to the end. Looks like we have a few people on. Does anybody have any questions for Matt? He's a wealth of knowledge, and I'd love to take advantage of the time we have together here. So if you do, drop your question below. Let us know, and Matt will answer some questions here. Um, let me do this while people are thinking of some questions. Are there any like books, routines, habits, any success tips that you've came across or practiced in your adventure to creating this successful real estate company?
Yeah, there's a few things come to mind. There's a couple different aspects of that question, but the most valuable real estate is between your ears. It's your mind, it's your head, it's your mindset. So before I really started getting into physical property, I really worked on my mental property and thinking about mindset. So, and I'm sure in other shows you've really got to dive into that. But books that have helped, I mean, everyone mentions Rich Dad Poor Dad. That shifts the mentality. I really like The Millionaire Real Estate Investor. I've read that book like 6 times. It's Gary Keller, Jay Papasan. Fantastic book. I mean, it takes you. I believe it was a memoir from Gary Keller to his son, and he wrote it in like very fast, like a weekend or something like that, or at least a portion of it, the first chapter. And it's very thoughtful. It's very in depth, and it really takes you through the roadblocks, the mental roadblocks that you could experience on the way to becoming an investor, and why those roadblocks mentally, why they're not there, and why you create them and how you can overcome them. So that was a great book. And there's just so many others. I mean, I've probably read over 100 books on investing and mindset, and just like the top ones that you Google, sales, negotiating, stuff like that. So if you're hungry and you want to go read and learn, you can just Google and read all those books. In terms of habits, I get up I mean, not like super early, but I'm up early, and I try to do my first top priorities of the day first. And I really just shut everything off. I don't do anything until that one thing is done. And usually it's 2 to 3 hours of doing that thing. But then after that, I respond to emails and stuff like that. So that's just a practice that I've done I say like, okay, today, what am I going to get done? I get it done first, and then I do the rest of the stuff.
Yeah.
So
And sometimes that might be the hardest thing or the thing that you're least excited to do, but it just needs to be done
yeah,
to get it out of the way.
yeah.
So many good gold nuggets, man. I'll drop those books in the show notes. But are you excited to see the man himself, Robert Kiyosaki, at the next event? Hopefully, you're going to be there.
Yeah. I'm still I'm up in the air, which is sad to say because there's a commitment I might have to be at, but I'm going to try to come as much as possible. But yeah, I mean that's I'm super excited to see Robert if I'm able to go, and I'm sure it's not going to be like, I mean, I've probably consumed hundreds of hours of it. I mean, probably thousands of hours of his stuff, and so it would be nice just to shake his hand.
Right? Or at least get a picture, right? So,
Yeah, exactly.
and so for people who are wondering, shout out to Investor Fuel. Mike Hambright is going to be um, getting Robert Kiyosaki to come speak at the next event that Matthew and I are a part of the group of the Investor Fuel Mastermind. And so it's going to be fun. I hope you make it, man. But that's all for now. Where can people learn more about you and your company?
Yeah, sure. So I can be found pretty much anywhere online, pezonproperties.com. That's our website. So that's a great place to start. And basically there we list everything out about what we do, our offers, products, services, and that's a great place to start. And then all of our social media stuff, Facebook, Instagram, and all that. We post before and after shots of our renos and all that, all the good real estate stuff. So social and our website.
Beautiful. Well, go check out Matt's website. Go give him a follow on the socials. And thank you all for being here. Appreciate you, Matt. Appreciate all your wisdom. Until
Sure.
next
Thank you
time,
again so
guys.
much for having me, Michael.
Absolutely.
Yeah.
All right.
Cheers.
Thanks for tuning in, guys. We'll see you next time.